All right, Ron. He said, I had a put on my JPM stock and sold it when it was up 140%, but didn't add another one and just left it as a covered call. Okay, so we're talking about that married put approach here, or maybe it was just a long collar, but close to the married put is what I'm gaining from Ron. So we had JP Morgan at a certain price, and let me just do this way. JP Morgan here, we're going to go out, let's go out to August. And I'm going to say I bought a, oh, no, we didn't. I bought a 270 put. Why am I buying a 270 put? Well, I just want to see something real quick for Ron's question. I don't need the specifics, Ron, but let's just take a look. Okay. So this is a deep in the money put that only carries a risk of 1%. And I'm not saying I bought the August 270 if I'm opening a married put now. What I want to do is just get that in there. I'm going to go to big charts. Okay, and let's say I bought JP Morgan back here at 265. Okay, but way back here when it just broke above the Bollinger Band, had a Bollinger Band breakout actually. So maybe, I'll use 265. That's a good price. So we bought this at 265. And at that time, I might have bought the 270 put, but it wouldn't have been 40.75. We're probably talking about $15 here. So let's go ahead and put that in. Maybe $18. Okay. Let's go ahead and submit that. Yeah, maybe a little bit lower. Now 13. Sorry, folks. I want to get the risk up to about 5%. 2.9. I wanted to go higher. Apologies. 17. Perfect. 4.3. That's good low volatility here in this case. Let's just add it to the portfolio. I'm just going to use that February 7th portfolio that we discussed, had open recently. All right. And let's just submit that. Okay, so not a real married put, but this is about what I'd expect to see with JP Morgan. It wasn't 314. My apologies, folks. That was back about a month ago. We're not going to edit the date, but you can edit the date very easily. Just go to position actions, edit position, if you entered the wrong price for the stock or for the option and so on. Okay. And I'm close, right in the wheelhouse. This is what I was trying to do. I'm right in the wheelhouse of what Ron was saying. Had I bought JP Morgan Chase a month ago at 265, bought the August 270 put at that time for $17. We saw we had a risk of about 4.3% on the position, and right now we're at a loss of 3.3%. And my put's now up, theoretically, 136, right in that wheelhouse of 140%. Now, he sold it at that time. Didn't add another one, but just left it as a covered call. But I'll just keep selling covered calls until it goes back up. Okay. I also did a bear call spread on Google. Okay. All right. So Ron, here's what I want to take a look at. Let's go to the profit and loss chart again for the married put position. I'm in this married put. I opened it about a month ago before the pullback. If I just owned shares of stock right now at 265, just shares of stock, and the stock has now fallen down to 232. What are the common approaches that an investor would use to manage this position? Well, number one, of course, we would talk about averaging down. I just own the stock, not a married put. This wasn't a covered call. I'm just a stock owner. And the stock's fallen down from 265, of course. Oh, sorry, folks. There we go. The stock's fallen from 265 down to 232. We'll call it 232. And it was down a little bit lower, of course, recently, but it's about a 13% drop, 12.5% decline. So I can buy another 100 shares right now at, we'll just call it 232. And that's going to give me an average cost basis of about 248 or so, right? If I'm not mistaken. Okay, so that's one approach. We can average down. It's actually 248.50. All right, number two. I could do the stock repair on power options. We're going to take a look at that in just a moment. Okay, so I could do the stock repair position, ratio call spread to try to find a ratio call to help me get back to break even with less of a move. I'm going to jot these two down here. My 248.50 if I average down even 100 shares. Now, in my situation, this is very similar to what Ron is talking about. But in this situation, what I could also do right now is just say, hey, I've made 140%, as Ron did on my August put. I bought it at 17. It's now at 29-ish. Oh, no, it's way above that. I'm sorry. It's at, it's 40. Okay, so we paid 17 for it. It's at 40. Let's go ahead and sell that. All right. And my cost basis is 241.82 on a stock trading at 232. So what Ron's saying, and this isn't his exact example because he mentioned he did some other strategies with this, and that's fine, Ron. I like your plan with the bear call spread that you did. But let's talk about management techniques. Okay, I had a married put to begin with because I'm protected. Ron's example said he sold the put when it hit that 140% profit, or when he thought he hit a bottom on the trade. We'll talk about that in a moment too. But he would have lowered his cost basis down to 241.82. Now say, okay, the stock's at 232. I'm down 9 points, 940. Is there a call available somewhere at or out of the money? Standard April expiration. Going to get $9? Not really, but 30 days out, I can get half of it. I can do the 240 call in this case, and I can get back to break even that way. Okay, so that's a 1.3% return if JP Morgan recovers above 240. Because I had the put in place, I took that off. So 240 call with a cost basis, I'm sorry, of 241. We've lowered it down to 236. Hey, we're in the wheelhouse. 240 April call at $5 roughly, $4.90. And that gets us a 1.3% return if the stock recovers. Advantage. I lowered my cost basis because I had the married put in place to begin with. That's what Ron's talking about. One of the benefits of the married put and having it in these cases, following the rules in the blueprint. But now just selling a call, if we keep in the correction territory and continue down, the hedge that I have now remaining against my new cost basis of 241 is just the 490 I collected. If it drops another 10 points, I'm still 5 points down from that new cost basis. But chance to recover, make 1.3% on the return. Now, I didn't have the married put. I add another 200 shares at a cost basis of 232. This would bring our average down to 248.50, but I now have 200 shares. Standard stock approach. Nope. Okay, let me just do this real quick, folks. I apologize. 0 days. Call. No. Call and put. Sorry, folks. I'm adding a synthetic on top of it. Okay. So now essentially my cost basis is 49,700. Having the married put in place in this client, taking the profit off, reduce the cost basis, and my current stop price is 232, but my cost per share is 248.50. We reduced the cost base essentially down to 241.82 with the put and didn't have to put more money into the position. Or could I still sell the covered call against us? Yes. We looked at the April 30-day out. This is going to be a weird profit and loss chart. I apologize. 240 strike at 490, right? Here we go. And yeah, let's clear these two out. This is what it would look like here. I'm not at break even. It's interesting, isn't it? How that put helped us lower the cost basis more to where if we did sell the April 240 call at 490, now the stock at 232, we had a better average cost than trying to average down the stock with a new 100 shares, where the same April 240 call, managing as just a stock owner, averaging down and selling the call, puts us at a loss at 1.5% in 30 days, where we are at a profit of 1.3%. Having had the proper structure in place to begin with the married put, taking that profit off of the table and doing it that way. Now, the third thing I mentioned, we're going to look at the stock chart in a minute, but we're going to go back to the power options tools. And we're going to go to our signature tools, and we're going to go to stock repair. And this is just a simple tool where we put in our initial price. And I had it 265. Is that right, folks? It was 265 was my initial stock price. Let me check my link over here. Yeah, 265. I'm sorry. Now, I was ahead of myself here. JPM. Let's do that correctly first, ladies and gentlemen. Let's put in 265. And let's put in 100 shares. And let's submit. What this tool, what this tool attempted to do was go out and find a ratio call repair where I'm buying one slightly in the money at the money call somewhere out in time and selling two higher strike calls to get a net credit. What essentially I'm doing is entering a bull call debit spread. In this example, I'd be buying a 230 call for April 25th expiration, selling a 235 call in a bull call debit spread, and selling an extra 235 call that's covered by the shares of stock. So I have a covered call with a bull call debit spread. And if the stock recovers as we expect, we get the $5 back from the bull call debit spread, the extra premium from that covered call. But we're seeing here that there's no break even. The stock has fallen too far. What if we do the average down? I buy another 100 shares. We get our cost basis down to 248.50, and we increase our shares to 200. Now that I've added that, now I've got 47,000 invested in this position. I do have a repair for April. I could buy one 230 strike and sell two 240 strikes for a net credit of 5 cents. And that gives me a good break even of 239.23. Remember, my cost basis is 248.50. How can I get a cost basis, a break even of 239.23? We take a look at the repair details here. We could buy two 230 straight calls for 25th of April at 10.55 and put out another $2,000, 2,110. We could sell four 240 calls at 5.30, which would bring in 2,120. So we're only getting $10 or 5 cents of net credit. But I've got a 10-point spread, meaning I've got two April 230 calls that were bought and two 240s. That's a bull call debit spread, which I technically didn't pay any money for. I received at a credit. And at the same time, what do I have? I have my stock with a new cost basis and a 240 call sold against it. So if the stock does move back up to 239.23, I'm getting 9.23 back for my long call. The 240s expire worthless. And where does that leave me? Well, remember, my cost basis was 248.50 initially. And if the stock hits 239.23, I'm still down about 9 points. But we took in 5 cents. The loss is 9.27. The long call value, that 230 call I bought, is going to be worth $9.23 of intrinsic value. So I am back to break even with only needing the stock to move back to 239.23. Let's take a look at analyze trade. That'll take us to our profit and loss chart for this position. We have a new adjusted cost basis of 248.50, but we have 200 shares. We got $47,000 in the trade. We buy two here and sell four. Two of the sold, nothing's naked here. Two of the sold calls are covered by the 230 call for that bull call debit spread, and the other two are covered by our now 200 shares for the covered call. And we reach the point where if the stock is trading above 240, the maximum return, because it is capped, is only 0.6%. But remember, even if we had the put to begin with, in the married, well, let me review it this way. If we just had stock only, just trading stock, there were no repairs. No repairs were available because the decline was too far. If I had the stock and I averaged down, we have a repair where the best case scenario is a profit of 0.6%. I had the married put to begin with. I closed the position, closed the put, as Ron mentioned, sell that 240 strike covered call, the same April one we were looking at. This was April 25th, though. And we had the potential for a 1.3% return because of the lower cost basis. And we still only had 26,000 invested, whereas here, averaging down, we had to put up another 26,000, so we have $49,000. Okay, let's just call it $50,000 really invested in the trade. And then, of course, we saw the other adjustment where we were at the loss of 1.5%, just trying to sell the call after averaging down, not using the stock repair. That was the other key. Averaging down and using the same 40 strike here that got us a 1.3% return was a 1.5% loss. All right. So what I'm saying here, what I've just went through that exercise for is, number one, we have videos on this, of course, on the YouTube channel. Let's go there, and I want to search across our channel. My apologies. I want to search across our channel for, I don't want to do market hedge, repair a sunken stock. Let me try sunken stock. I think that's the best one to use. Sunken stock. All right, strategy ideas to repair sunken stock. So you have a covered call that's down in price after this return. Using the stock repair tool. Just a stock, if I just sold covered calls, I do the stock repair, covered combination, transferring to a married put, revisiting the stock repair tool. So you'll see some ideas on here. Get back to break even faster, some comparison ideas of just what we walked through. Just doing it as a covered call, doing it as a covered combination, using the stock repair tool. But of course, what I'm trying to illustrate is avoid the need to repair sunken stocks. Have the proper protection in place to begin with the married put approach for these uncertain markets. Then instead of having to add another $223,000 to average down the stock, bringing your cost basis up to double and risking to the downside, double the amount. Using that put, the second working asset, is one of the 13 income methods discussed in the blueprint, income method number 9 in that scenario, and averaging down the position but getting paid to do it instead of put more money into the trade, starting at a point where, of course, we're still bullish, but we've capped the loss on the trade instead of capping the gain, and we've left the upside open as well. All right, so Ron, I liked your approach, and we saw it looked good by averaging down with the, or not averaging down, but closing the married put, taking that 140% profit, selling a call now that we were seeing the buy warnings at a 240 strike, a little bit out of the money. My numbers were close to yours. You just told me you got it about 268, and you did some other adjustments. But that covered call that you're in now, you're looking at a 1.3% return. And in my scenario, you're looking at a 1.3% return, right? But of course, those ideas there, always good to review. My stock is down. What is the comparison of just trading covered calls against it? Averaging down and then trying covered calls against it. Using the stock repair tool. Averaging down and having to use the stock repair tool because no repairs came up. Using a covered combination and then going into married puts. And on other discussions, get back to break even faster, as I mentioned, revisiting the stock repair tool. And of course, just an easy idea, avoid the need to repair sunken stocks by having the protection, guaranteed protection, better than a stop order, in place in the first place on the position. So we don't have to worry about using the stock repair. But it is a powerful tool for these scenarios. But again, if you don't see a repair, you might need to average down. And we talked about the risks of those using, putting in extra money to now having to average down instead of having that second working asset for uncertain markets on your long-term positions as well. Paul, it'd be the same effect. So here we are at 265. Remember, we averaged down. I bought another 100 shares at 232.44 before the stock repair, before selling the covered call, Paul, and that would have put my cost basis or my involvement into the position at 248.50 for 200 shares. And that was at about 47,000. We're going to call it 50,000, 47,960. So Paul says, could you just add a synthetic long instead of adding 100 shares? Synthetic long, of course, with the stock at 232, I might buy a 232 call, let's say 4 or 5 months out in time, and sell the same strike put for the same expiration. It represents a synthetic long position. Okay, so these numbers here, 24,850 or 47,960 invested in the trade or maximum risk. Could you do it, Paul? Yes. Is it going to be much different? No. Risk reward? Absolutely not. So we go to view options. I said August or somewhere around that time frame. Let's just use July, Paul. I don't think the volatility is going to matter. 230 call, 230 put. I'm going to buy it, synthetic long stock, buy a call, leaves the upside open, sell a put. One does not cover the other. I'm now in a naked put at 230, and I have to pay the price to buy the call option. I'm going to get premium back from selling the put. Normally, you want to do this at a credit. Maybe we'll use the other strikes, Paul, to do it at a credit. This is done at a debit of $3. My total requirement is exactly the same, $49,865, meaning that I have to put up the monetary requirement. You could use margin, but you know the risks of that. Selling this 230 put, it is not covered by owning the stock. It is not covered by owning the long call. I still have to put up that $23,000 to enter the position, plus I have a debit here of $365. Cost base is $49,865. In this example, it's just $100 less than the $47,960. And it's JPM. And the reason why I say that is if I'm holding this long term, I'm going into JPM. This has happened. Let's see. Next ex-dividend date is coming up on April 6, 2025. So because the dividend paying stock, Paul, in this situation, I'm buying the extra 100 shares if I have the money. I'm not doing the synthetic long because I'm missing out on an extra $1.25 that I could get in, 22 days by owning that extra 100 shares of stock. I wouldn't deny myself that in this case. If you had some kind of weird implied volatility skew on the stock that you're trading, Paul, and it doesn't pay a dividend, maybe I'd use a synthetic long. But it comes out to be the same mathematically because the obligation. Let's try to get a credit for the synthetic long in your case, Paul. I'm going to stick with July, and we're going to use the 235s, but I think this is even. So it might be a little bit more cost effective. Buy the call again, 235 strike, slightly in the money. I'm sorry, slightly out of the money. Strike that, reverse it, and sell the 235 put, Paul. We use midpoints. Yeah, now I'm getting $1.30, but still, I increased the cost basis by 5 points from 230 to 235. I'm at 49,870. Okay, it's still $90 less than buying another 100 shares. But again, with that synthetic long, looks the same as averaging down, got my price down to 249.35, right about where the other two were. Remember, buying the extra 100 shares of stock, we were at 248.50. And in that 22 days, if I don't decide to close the position or I get break even, Paul, or anything like that, then I'd make the adjustment. Now, risk inherent with this structure and doing the other combinations that we mentioned. What do I have now? I have one long call. I have a cash secured naked put that I had to put up 23,500 in this example, Paul, to do. And I've got my 100 shares. If I do the stock repair at this point, I'm going to buy one call. Well, we were April 25th, 230 strike, right? Buy one call at 230 and sell two calls at 240. Okay. Now, this gets kind of weird depending on your broker. They should read it. They should link this extra call to this stock, which they probably will. And they should link this bull call debit spread, which they probably will. The risk inherent at this point is if your broker, for whatever reason, links it to this 235 call and gives you a calendar spread. Now, you still have the long stock, which would be unlimited upside. But if they link it to this and the stock moves above 240 and you get assigned early, you might actually be here on the calendar spread. They might exercise the long at 235 to deliver the short. You still have the stock unimpeded. You still get the profit on the bull call debit spread. But you still got the 235 naked put. But if they exercise this long to deliver the short, you're liquidating here, not here at the peak and not here where the standard covered call would be for the repair. Odd trick that's happened a couple times to investors that I've talked to, trying to do the ratio repair, the stock repair on a calendar spread instead of a straight covered call or on a long call where they got exercised early, but the delta on the long call wasn't one. They're in the money call that they originally purchased that eventually recovered. It was losing, then it recovered. It was more of a calendar spread because the repair was shorter term. So they had to exercise long to deliver the short, which meant what? They didn't get the time value that still remained in this long call. So the calendar spread, which would have looked like this, they actually got closed for a loss or a small gain over here because it was just based on the difference in the strike prices. They didn't get the time value remaining on this July call when they were signed in April. Shouldn't happen in this scenario, but it's something to consider. But also just remember doing that ratio repair now that you're using a synthetic to average down, but you still got to put up the money to cover the cash secured put, Paul. That's not covered by anything in this equation. Once I add the stock repair, that's also not covered in anything by the equation. The only way to cover this is to buy a put one direction or the other, or try to use some conflated ratio put spread and then try to do a stock repair. And at that point, you're talking about 9 legs, and I wouldn't even be able to follow you in a coaching session of what you did. I'm just going to be honest with you directly. That's just how it works. Okay. So that's why in general, especially on a dividend paying stock, I would never use a synthetic to average down the long stock shares.